Welcome to Fixated, the Fixed Income Podcast. I'm your host, Elizabeth Moran, Editorial Director of Fixed Income News Australia. Join me as I talk about the latest news, views and education in fixed income investment. I'll be joined by industry experts from Australia and across the globe. Welcome. Today I have with me in our Brisbane studio Harry Hardy, who is Associate Investment Director at Fidelity International and based in London. Welcome, Harry.
Thank you for having me.
You travel quite a lot for work. Is this your first time in Australia?
This is my first time in Australia. It's the first time I've managed to venture this far out, and it's been great so far.
Fantastic. And you're in the heart of Bluey Land. And are you taking any souvenirs home for anyone special?
I will definitely take quite a few souvenirs home for my 3-year-old. When I was explaining where I was going in the world, I said it's the home of Bluey, and he kind of understood a little bit at that point. I'm going to be a little bit further away from home for the next week.
Oh, fantastic. And while you're here, what are you doing? What are you getting up to?
So I flew out on Friday morning, landed in Sydney quite late in the day on Saturday. And really, Monday and Tuesday so far, we're in Sydney, meeting with a lot of advisors, clients, consultants, etc. And we had a really interesting lunch yesterday as well with a broad range of prospects. And we've had some really good discussions. It's obviously a very topical time at the moment with everything that's going on. So almost a perfectly timed trip.
Let's turn our attention to the market. We saw investors turn away from the US market a few weeks ago when Trump's Liberation Day tariffs were announced. Is the US still the world's reserve currency? And are US government bonds still considered a safe haven asset?
I would say yes, they are considered a safe haven asset. But however, that full process has obviously been challenged quite a bit recently. Something that we've really been trying to drill home to a lot of our clients, just to provide a lot of context, is, for instance, whilst the moves in April were particularly choppy, and what I mean by that is post-Liberation Day, for instance, the 10-year rallied to around 3.8%. At times in the month, it hit 4.6%. So we had an 80 basis point swing, which is pretty huge by any kind of metric. But actually, if we were to take a step back and look at what the 10-year did for over the month, really, the moves were not that severe. They were a couple of basis points higher, which is really interesting because if somehow you were swept away on a desert island and maybe only looked at what happened over the space of the month, sometimes we have moves that are far, far more severe than that after, say, an NFP print or a CPI print. So I think at times, whilst there is a lot of volatility that's ongoing, we also kind of have to take, some context and step back. And even, for instance, if we flash back to around the middle of January where we had some data surprises to the upside, the 10-year was up at 480 at that point. We're still below those levels. So, whilst there is a lot of noise, it is going to continue in that fashion. I think we all kind of need to take a step back and maybe provide some context behind that.
So would you consider investing in US government bonds even longer dated than the 10-year? Would you be hesitant in that space?
I think that's a really good question. So how we are concentrated in a lot of the global fixed income portfolios currently is we have a key overweight position in that 5 to 10-year part of the curve. Obviously, 1 to 7 years is very much a function of the Fed funds rate. That overweight in the 10-year part of the curve as well is around some concerns around growth prospects in the US, etc. But to come back to your initial question in terms of longer term yields, we have a small overweight in the 30-year part of the curve. That is being tested at the moment. And we did reach a few points earlier on in the week where we'd hit 5%. We've had a slight pullback from there. But I think from a yield perspective, whilst there are many unknowns from, say, a physical perspective and how that unfolds, from a yield to maturity perspective, there is a lot of protection within that.
What other flight to quality assets did you see investors seeking? And did you actually move some of your higher quality assets into other buckets or other assets?
So I think that's a really interesting question. We've been positioned quite defensively for quite some time. So if we're coming into this year, we've had a long US duration bias. Obviously, we've touched on how that was particularly volatile in those kind of periods. In the aftermath of Liberation Day, we took the opportunity to trim back a little bit of that duration position, whilst we've added a few pieces back here and there. What we also saw was a rally in the Japanese government bond curve, and we actually were underweight at that time. So we took the opportunity to increase that position, which has since paid out relatively well from a relative returns perspective, being that we have seen a somewhat sell-off in that curve.
Just in terms of US government bonds, do they still act as a hedge towards equities and US equity positions?
I think that's a really, really good question. And I think that's we're probably talking at a juncture now where that has been tested. Once again, I do think volatility will persist. I do think we're going to have other sharp moves depending on headlines, how the US economy unfolds, the narrative that we start to hear out of the Federal Reserve. But I still believe that US Treasuries do act as a hedge. Once again, that was tested post-Liberation Day, but we'll have to see. But I do feel that once again, with the yields that we have on offer, that does provide a balance within a portfolio.
Okay, I find it quite interesting that the US equities are back above where they were pre-Liberation Day, right? They're like,
It almost feels like
can anything go wrong? Can anything really dent that momentum of that train or whatever you want to call it?
It's a great point, because actually, if once again, coming back to my initial point that we touched on in the intro, if you're on a desert island and just looked at your monthly fact sheet, it doesn't appear that a huge amount has changed. But what I would say, probably to challenge that as well, is it's not just US equities. If you were to look at US corporate IG spreads, we've had a view coming into the start of the year that they are particularly rich from a valuation perspective. Okay, we did have that widening post-Liberation Day of 30, 40 basis points. But once again, they are back to levels that we saw pre-Liberation Day. And I think that's just as interesting as the moves that we've seen in the equity market, because it doesn't appear that much has changed. But I think a lot has changed. Whilst we're still at those stretched equity valuation levels, at least from a headline S&P 500 perspective, there's much more unknowns, or many more unknowns rather, for those firms and how they navigate the landscape. So I think that will be tested over time. Once again, we are up in quality. We have a preference to that 1 to 10 year part of the curve in the US IG space. So we will have to really see how that plays out.
I find it really fascinating because often bond analyst thinking is quite different to equity analyst thinking. But is it? And I do think we do think differently, us bond analysts. But is it because there's so much money looking for a home and wanting certain minimum returns, and yields are still good on bonds? If you look at the overall yield on IG American corporates, I mean, I don't know what the average is right at the moment, but that's still relatively attractive, isn't it?
I think that's the key point, and that really links into what we mentioned a moment ago in how rich US IG corporate spreads are. Because whilst if you're looking at that from a spread perspective, so from if our credit analysts are analysing them from a very kind of top-down perspective, or you have a fund manager taking a view, most definitely with the unknowns that we have, those spreads don't seem to offer much compensation for the risks ahead. However, if you're a buy-to-hold investor or a institutional client, a pension fund, insurer, etc., from an all-in yield perspective, they remain quite attractive. And I think that technical force is likely to remain quite strong. We have a view that, there might be quite a bit of complacency within that, but I think that is going to continue to persist as a technical support going forward.
It's very interesting. In the Australian market, we see new issues come all the time, but they're marketed at a certain, spread. And typically nearly everyone I'm looking at the moment, the spread comes in because of demand for the issue. And it's like the demand is massive.
I think that really supports the point that you just made. If you look at where the new issue premiums are, there isn't much being given away to participate in a lot of those primary markets. So that's something that we really focus on at the moment. Whilst we do, of course, have firepower to increase positioning within the funds, we will drop out of new issues where we don't feel that there is a adequate new issue premium to participate in that. So I think that's 100% right.
In terms of the US, there's been quite a bit of talk about stagflation and the possibility of a recession. Do you see either of those scenarios playing out? What sort of probabilities might you consider for those scenarios?
I think stagflation is definitely on the tip of everyone's tongue at the moment. Many forecasts that you see or many scenario analysis that houses put out, that's definitely something that's gone up in terms of weighting as a probability. I would say the stagflationary one is interesting because it really depends on the magnitude of how high the inflation is versus how low the growth is. So one of the views that we have is that whilst the stagflationary episode does materialize, we could also see a scenario whereby the Fed is still cutting in that environment. And what I mean by that is, if we have inflation running, marginally above the core PCE target of 2%, given the Federal Reserve's dual mandate of price stability and maximum employment, if the weakness in the labour market does emerge, that could really be the side of their hand that is pushed to cut. So I think that is definitely a probability. In terms of a hard recession, that's not our base case, but we are expecting a material slowdown in growth. given the uncertainty, given the headwinds that the US consumer is currently facing. I know we discussed a little bit offline, but that trading down component, I think that's something we can all kind of relate to on a personal level. That 2022, 2023 inflation that we have, we've all had those moments where we go through the supermarket and we view that wasn't the price that we had a couple of years ago. I'm going to maybe trade down from a premium brand to a more kind of budget offering. And I think that's really playing out. So one of the challenges that we see, whilst inflation is likely to be a little bit sticky with everything that's ongoing with the tariffs, what is the capacity of consumers to absorb that? And that's something that we've been doing a lot of work on recently.
Or some of the prices for some of the goods, like chips, or you call them crisps, but like half the packet size and still the same price. And you buy the biggest packet now. I buy the biggest family packet.
Shrinkflation.
It's shrinkflation, exactly. It's really prevalent, and some of the shortages in like olive oil and cocoa, and really impacting how people think and shop.
And we feel that every day, and everyone feels that.
Just going back to the growth and global economy, we talked a little bit about US. How much does the US growth impact global growth, and do you foresee the rest of the globe slowing down with the tariffs? I just like your thoughts on global growth.
That's a really good point. I would say just coming back to that point that we mentioned on the US consumer is the reason we spend so much time, analysing what is going on there, and even though we're here today to talk about, a fixed income offering, we spend quite a lot of time with our equity analysts, like really trying to have a flavour of what's coming out from these big corporates and what they're seeing on the ground. The US consumer is particularly important because they account for around 2/3 of GDP growth in the US. So the cliche point that we often make is, if they catch a cold, that's definitely something that the rest of the US will feel. Given the importance of the US on the global stage, and I know, there's much going on with their role in the world at the moment, if we do see that slowdown in the US, that will really weigh on the landscape for European growth going forward. And I think there's going to be a scenario where, if the US does slow down, the ECB is also going to have to act accordingly. Obviously, we touched on a little bit prior to the podcast about the trajectory of Australia. One of the views that we have is actually the Aussie economy is on much better footing than many actually market participants would believe. So actually, in terms of what the RBA is going to do, I know we've had that cut yesterday, but we actually think there's probably not going to be anywhere near as many cuts are actually priced in for the Aussie economy as what the market is expecting at the moment. I know we touched on as well, actually the employment landscape is quite tight here and the inflation's still running quite hot. So there's definitely diverging trends across the globe. And I think that is, really why a global fixed income portfolio is compelling at the moment, because there are those opportunities to express different views depending on where you see different trajectories unfolding.
Well, of course, the Australian market is so small on the global landscape. What is it, 1.6% of global bond market, or it's tiny?
It is small within our universe, but it's definitely an active position that we do have at the moment. So we are long Aussie FX in the fund. That's more of an expression of how we have a view that the US dollar is going to weaken, and we've had that position since the start of the year. And we've really tried to identify currencies to express that view against. And interestingly, AUD is one of those.
Oh, that is fascinating. Just talking about a global bond portfolio, can you talk about the mix of assets that you might have in it at the moment? Is it still heavily weighted to the US?
Yes. To answer your initial point, it is heavily weighted to the US. If you look at a global aggregate, i.e. a global bond universe, around 45% of that is still weighted to the US. So I think that really is a testament to the importance of having a very strong view on the US, being active in that region. Within that, you have US corporate bonds, you have agencies, you have municipals, you have also a mortgage-backed security component within that. So it is very vast, at just less than half the benchmark weight.
So even just looking at the strength of the US, it's worth having global diversity in that fund to try and counteract any spikes or imbalances in the US with an uncertain Trump administration. Is that fair?
Most definitely.
Okay. So is it appropriate to be adding duration at this point, do you think?
In our view, yes. But I would say cautiously adding duration. I would say our main position within the fund, or main active duration position currently, is an overweight stance in US duration. So like I touched on earlier on, that 5 to 10 year part of the curve is where we see most value at the moment. And we have a very small cautious long in that 30-year part of the curve. Whilst, from a valuation, i.e. yield perspective, it is very attractive. It's not quite a level at the moment with the unknowns that we touched on where we're going to really be ramping that up, but it is a cautious long that we're maintaining.
One of the things I find interesting at the moment is you're still seeing, 4.5%-ish around there for US 10-year, right? And some of the corporate spreads are not that much higher than that 10-year. So would you have a preference for government or govies over corporate bonds? What's that weighting mix like?
You're 100% right. I would say that you're still, if you were to look at the US IG corporate index, it's still around 90 basis points above US Treasury. So you are receiving a pickup there. That is very tight from a historical perspective. It's not quite as tight as we did reach at points this year. We had times where we were looking at US IG corporate spreads and they were inside their 1998 tights. And if you look at the quality of the benchmark from 1998 to where we are today, it's a much higher in quality universe than it was back then. So even on a risk-adjusted basis, it's far tighter in reality than it was. In terms of, to answer your initial point in how we're positioning the portfolio, we are very much underweight credit risk in the portfolio. So whilst on a market weight basis, you wouldn't really see that too much there. But if you really look at our spread duration position, our duration time spread, i.e. how we're actually expressing that credit risk in the portfolio, we have a very defensive credit beta of around, say, 0.6 times the benchmark. So whilst we're not expecting a material widening, we are well positioned to capture alpha, capture opportunities in that spread widening event. And really coming back to post-Liberation Day, okay, we had those 30, 40 basis points move wider. They have retraced that we've touched on and really challenged many times. We didn't see that as an all-out buying opportunity, but what we did try to do, really from a bottom-up perspective, working with our analysts, is find a few names where we felt that they had been indiscriminately sold and really use those opportunities to ramp up some positioning.
So, Harry, Fidelity International is this global enterprise. Can you talk a little bit about the resources that it has?
You're 100% right. We are a global enterprise and we have resources dotted across the globe to support the portfolio management team who are making those investment decisions. I think what's most important, or one of the most important factors rather, for the fund is our credit analyst team, which are dotted in Toronto, London, and various different hubs across Asia. And that really feeds the bottom-up positioning within the fund. So we have a very extensive rating methodology, which really, really supports the PMs and has been particularly valuable, especially in these challenging post-Liberation Day times that we've mentioned. In terms of a trading desk as well, and I think one of the unique factors that sets Fidelity apart is that reach that we have. And the trading desk sits side by side to the portfolio managers. So quite often, if one of the fund managers has a view of getting out of a certain position or there's names that they're monitoring, it's really that back and forth process of how that's integrated within the investment process, which I think is really one of our strengths. Now, often mistakenly, in many markets, we're known as an equity house. And actually, I think that's a little bit unfair in the sense that in terms of fixed income within Fidelity International, we've been running those portfolios for close to 35 years. So a real long-standing expertise. But those equity analysts that we do have are actually very valuable, even from a fixed income perspective, because the portfolio managers spend a lot of time identifying trends, turning points, etc. And they are really, really vital as part of that process as well.
I think that's certainly true. You're looking at the same companies, and if they're starting to identify a trend, can really help analysts, and vice versa. If analysts see, if they're sector specialists and they see things moving, or it can really work if you have conversations about just general directions of companies.
100%. And quite often what you'll see from a company's management is there's a different conversation that they might have with an equity analyst versus a credit analyst. For instance, share buyback comes to mind. Really equity friendly, not necessarily that credit friendly. So having that two-prong approach at companies is really vital for us.
I just wanted to talk about what Fidelity International might see as value in the market at this point. We've talked about US government bonds and credit spreads, US corporates, and you talked a little bit about that you see value in the Australian market. So perhaps if you can just touch on that a little bit.
So most importantly, we do have that overweight position in US duration. Currently at the moment within the portfolios, we're marginally overweight in core Eurozone duration. That's very much largely at the expense of peripheral debt. So we don't have any exposure to French government bonds, Spanish government bonds, Italian BTPs, for instance. One of those views there is whilst, we're giving up a slight bit of carry, if we do see those risk-off scenarios emerge, those spreads will struggle in that kind of environment. In terms of value, we're very much up in quality within our credit book within the fund. So a concentration in shorter dated credit, trying to maintain carry in the portfolios, and really kind of keeping that credit risk down within the portfolio is one of the key points. In terms of cash balances, we're probably running, a couple of percent, which is a little bit higher than maybe in the past. High yield's another interesting one because, historically in many of our global fixed income funds, we've had around 5-6% over the long term. We're actually closer to around 3%. So a big factor of that is where we see spread valuations in high yield at the moment. I would caveat that point, in the funds that I cover in my role as an associate investment director. When I say high yield, we're mostly focused on those double Bs plus and double Bs. So the higher end of high yield and where we're trying to identify those rising star candidates, etc. But we're at a lower range in high yield currently.
So, Harry, can you perhaps just touch on private credit? I know a lot of our listeners are thinking about that market at the moment.
Obviously, within the mandate that we're here to discuss, so global fixed income in a IG setting, that isn't necessarily part of our investment universe. Of course, I can understand the appeal from a client perspective. The yields are particularly attractive, which is very much an important factor. But kind of really linking that back to our views around high yield and why we're defensive in lower quality assets is obviously with the unknowns that we have in a risk-off scenario, the challenging growth prospects, etc. There are many unknowns. And I feel that there is a reason why you are paid that yield. And I think maybe there are scenarios where maybe clients don't fully understand the level of risk that they are taking to receive that yield. I made the joke yesterday that there's no such thing as a free lunch. There's a reason why you have those yields within the portfolio. So our preference at the moment is to be up in quality, investment grade fixed income. So not a huge part of our investment universe, but I can understand both the pros and cons from an investor perspective.
I think it really depends on your goals, whether you're looking for yield or you're looking for that defensive, robust, capital preservation part of your portfolio that I think really is traditional fixed income. And there's a reason why these massive global companies have very high weights to defensive fixed income.
Exactly. And that's what we're here today to discuss is defensive fixed income.
So while we're on that note, can you perhaps talk about your retail fund here in Australia?
So the Fidelity Global Bond Strategy, as I touched on previously, has been running for around 35 years. So it is one of the longest track records that we do have on the platform. But importantly now, and specifically for the Australian market, Australian clients now have the opportunity to invest in this vehicle. I think a few key messages that I'd like to finish on is that the strategy is carefully contrarian. We are more than comfortable going against the grain. We're not tracing kind of consensus fall, and that really is important for a fixed income allocation. We're defensively minded with a focus on liquidity. So when we buy a name, it's with the view of, can we get out of this name easily? And that's really important, especially in these times of stress. Something that we really like to drill home to clients is we like to have firepower within the portfolio to be a buyer of risk when others are potentially a false seller. So, we touched on previously those post-Liberation Day sell-offs. Whilst we didn't ramp up exposure materially, we were in a position to take advantage of those dislocations, which is really, really important at the moment. We're a high conviction fund. Currently, we have around 200 issues within the portfolio. So we are concentrated within our positions. But that's really where we leverage on those credit analyst resources that we touched on, the equity research team, and all the resources that we have at our disposal. And just really, really to finish, we are a true to universe offering. We are not a strategy that is marketed as high yield and there's loads of aggressive risk beneath that. We are a fund that essentially aims to do what it says on the tin.
Fantastic. Harry, thank you so much for joining us, and we wish you well in Australia. We hope you have a wonderful time and carrying Bluey back under your arm to London. And thank you very much for joining us today.
Thank you very much for having me. It's been an absolute pleasure.
Thank you for joining us this week on Fixated, the Fixed Income Podcast. Still hungry for more fixed income news, views and education? Then visit fixedincomenews.com.au and don't forget to subscribe to our newsletter to have the latest news delivered right to your inbox. Thanks again for joining us. I'm Elizabeth Moran, and we'll see you next episode on Fixated, the Fixed Income Podcast.